Hello everyone, welcome to this video. In this video I'd like to talk to you about one of the key concepts that lies at the center of management, which is why is it so difficult to successfully run a business? So what you have to understand is that if you are a manager, then every day, multiple times in that very same day, you have to make decisions. And making a decision is not that easy because you have to weigh these decisions, right? You will have multiple options, you have to pick one of these, and then you have to commit to it, resources, time, space, and so on, and then you have to pursue it. So because you have to weigh these, there are a lot of ups and downs with each of these decisions. It's not clear, because if it was clear, you could automatize this, and then perhaps a computer could simply pick the right outcome. But it's not that simple, and it is actually the skill of the manager to not only see which options are out there, but more importantly so, pick the one that will have the most benefit to your organization in light of other organizations and your competition with them. So actually the role of the manager, and actually the thing that makes a manager successful, is the manager's ability to successfully assess trade-offs and based on that pick the right outcome. So let's make this a bit more concrete if you wish, and let's think about companies in specific. So when a company starts with doing business, the company has to decide about what type of a product is going to be sold, right? And again, at the basis of this decision will be the top manager, the top management team, and its crew. So if you think about what type of a product you're going to sell, of course, first of all, you have to think about with what quality you're going to sell this product, right? High quality will, of course, attract a lot of people, right? It will increase your demand, but quality goes hand in hand with costs. And the question is whether extra demand that comes from a higher quality is going to be able to offset the costs that are associated, again, with this quality. Secondly, you will have to think about the amount of models that are going to come with this product, right? Are you just going to launch one model, multiple models? Because if you have multiple models, again, this will lead to a higher demand because you will be able to appeal to more than one type of consumer. But at the same time, having multiple models is going to hurt the efficiency in your factory, and it's going to hurt your automatization in your plant. And at the same time, of course, it will also hurt the focus of your employees, because now you cannot just focus resources on just one type of model. No, you have multiple models. For this, you'll have need to have multiple production processes, and your employees will need to focus on multiple types of products at the same time. Finally, just to keep it simple, you also have to think about your product's price, of course, right? If you're going to sell your product for a low amount of money, of course this will attract a lot of people. But you have to think about the cost side of things, right? If you have a lot of models, if you have a high quality product, then of course there'll be a lot of costs associated with this, and this is going to prevent you from selling a product with a low price, right? So automatically your costs are going to push your price high. The question is how high, because if your price becomes too high, then perhaps you will not get sufficient demand. And even though you might have an amazing quality product with a lot of models, demand might not be enough with that sales price. And again, you might not end up being profitable as a business. So just alone, if you think about what product you're going to sell, the combination of quality, amount of models, and price is already quite difficult to make for a manager. Lots of trade-offs associated with this. But let's continue, right? Imagine you have decided about what product you're going to sell. Secondly, you have to think about how you're going to sell this product, right? So you have to think about your marketing campaign, how much money you're going to put into it, and of course also which channels you're going to do your marketing through, right? Are you going to do it through social media, through the TV? Are you going to use other types of, let's say, outlets, billboards? Are you going to use all sorts of internet-based, websites to do your marketing through? Are you going to use retailers, yes or no, to sell your product through? Or are you just going to sell it through your own website or through your own stores? A lot of choices to make regarding how you're going to market, how you're going to brand your product, and how you're going to get it to the customer. Secondly, of course, what you also have to think about is the type of people that you're going to employ. So how much money are you going to pay them? How many trainings are you going to offer? What type of bonuses are you going to give them? What type of rewards are you going to give them? Because all of this, of course, plays into what type of employees you're able to attract and able to retain. But at the same time, also with what type of productivity these people are going to work for you. If you're not going to give them a lot, if you're not going to give them lots of incentives, bonuses, and so on, then you might end up with human capital, with workers that are actually not productive enough and actually not able to deliver what you want them to deliver. But paying them more, of course, is going to add up to your costs, and as explained before, this is going to, of course, turn into a dilemma with your sales price. So we've talked about what type of products. We're going to talk about, how you're going to sell your stuff. But then, of course, you also, this money has to come from somewhere, right? Especially if you're starting up your business from scratch. You need money to invest. But even if it is a business that's already ongoing, this business needs money for investments. And the question is, where is this money going to come from? Is it going to come from debt, right? So are you going to get money from banks, so through loans? If yes, then you have to think about that this money has to be paid back at some point to these institutions with interest as well. So it's expensive money, but you might use this wisely. You might spread this over 10 years, 20 years, and so on. It might be beneficial. Who knows? But you also have the option, of course, to sell shares, to sell ownership. This way, get money that you don't have to pay back to anyone, get money that you don't have to pay interest over. But the problem here is, of course, you're giving ownership to someone else. And this ownership, of course, is very precious, very valuable. And you don't want to give ownership just to everyone because this is going to go, of course, at the cost of your own ownership. And if your business is going to increase a lot in value, then this ownership is going to be, of course, lost a lot of money to you, because this ownership you could have also sold at a later point in time. So we talked about what type of products you're going to sell, how you're going to sell it, and with which money you're going to make your business work. But then you also have to, what goals your company is going to pursue, which of course essentially a strategic question, right? So you have to think about, is my company going to be profit seeking, or is it going to be, revenue seeking, or, is it going to go after social responsibility, or is it going to go after perhaps the share price? All of these, of course, are interrelated, but at the same time, it's very difficult to maximize all at the same time, if not impossible. So think about it. If you want to maximize your profitability, most likely you need to make this decision to stop selling extra products at some point, because selling more products after a certain point will require you to install more manufacturing plants. It will require you to hire more people. You will hit a lot of bottlenecks that are going to require you to invest more, and this is of course going to go at the cost of profitability. But sometimes you want to maximize your revenue. Why? Because more revenue means, of course, more exposure. It might increase your brand image, because more people will know you. Perhaps you're everywhere are your products, and you might not perhaps reach the maximum profit, but you will at least have a lot of other benefits that you might not get through a profit maximization goal. So Apple, for example, is more after profit seeking, but a company like Walmart or a company like Amazon, they're much more after revenue, not that much about having maximum amount of profits. And you see that these companies behave very differently because of this goal. Social responsibility we talked about. So social responsibility, of course, requires a lot of investments. It might increase, again, your image. With this, it might, of course, at some point increase your sales. But, you will have to make a lot of investments, a lot of commitments here that are not really directly going to lead to monetization, right? It's not directly going to lead to profits, not directly going to lead to revenues. Oftentimes, of course, the correct thing to do here is that if you're going to go after corporate social responsibility, it should not be a dark motive that lies behind this. And so the loss in money here is, of course, going to go at the cost of profitability and at the cost of revenues, because investments could have been used to directly monetizable types of investments choices. Share price, one of the things that's very important. Share price, of course, is a combination of all sorts of decisions that you make in light of the type of shareholders that you have. If you go after a profit, most likely this is more directly going to help your share price than, for example, if you go after revenues or after social responsibility. Then again, you need to balance all of this. It needs to be not only short-term focus but also long-term focus. So share price maximization is not that simple as it seems. Just going after profit maximization but in the short run might hurt your share price in the long run, and so on. So again, a lot of trade-offs here that you have to consider before being able to say, hey, this is my company and this is what I'm going to do. So basically what you need to get here are three things. First of all, you can invest, of course, as a business, but you can only invest one unit of money once at the same time. And then of course you have to time this investment, and you have to choose about the location of this investment. And these three things means that there's opportunity costs involved in your investments, right? How much are you going to invest in something, at what time and point, where? And these decisions have to be made by a skillful manager for your business to be successful. Then secondly, what's important here is that you have to not only deal with the today and not only have to deal with the future, but also with the past. In the past you made certain decisions. Some of these are related to your today and your tomorrow, and these you have to take into account when making decisions. At the same time, certain decisions in the past were simply bad decisions, and these you don't want to take into account in the future. And those decisions you need to leave where they are. And so a combination of the past, the today, and the tomorrow means that you're going to look at what is relevant for my decisions today in affecting the tomorrow for having an as good as company as possible. And this, of course, where the sunk cost concepts comes into play. You don't want to take those costs, those investments from the past into account if they are not relevant anymore for your today's decisions. Finally, we have to think about something that's called contingency theory, meaning that everything is related to everything else. It simply depends. Your company makes decisions, but it's not going to make those decisions independent of other businesses. And because your decisions have to work, you can't just optimize your decisions based on what type of company you are. You have to think about with whom am I competing and what type of a decision is going to make me flourish in such a playing field when I think about what other types of businesses I'm competing with. And only if you take these three things into account, being opportunity cost, sunk cost, and contingency theory, only then you'll be able to make the right decisions that will help your company excel and be the company that you want to be in a very competitive landscape. I hope you enjoyed the video, and if so, please don't forget to hit the like and the subscribe buttons. I wish you all the best in the world and hope to see you again in future videos. Take care.